Let's go over the units of usage method. It's another form of depreciation for fixed assets, which are long-term assets. It's also referred to as units of activity method. So if you see that, it's the same thing as units of usage. We have an example here. It's Black Star Corporation. They purchased equipment for $410,000. I did leave out that it has a salvage value of $10,000. So note that, please. We're going to calculate the depreciation expense for the first, second year, and third year. We'll go over the journal entries, and we'll also go over the net book value. Feel free to screen capture this or take a picture as we go through this problem. In respect to formulas, you'll need to do two steps. The very first step, you'll need to calculate rate. The formula for the rate is very similar to the straight line depreciation formula, which is cost minus residual value or salvage value. And instead of over useful life in years, you're actually going to divide it by the estimated total usage. After that, the second step is to actually calculate the depreciation expense. So again, first calculate a rate, and then after that, we can calculate the depreciation expense. To do that, you want to multiply the rate from step 1 by the actual usage. So for problems that you may encounter, make sure that you find the actual usage for each year because you need that to multiply by the rate you just calculated in step 1. All right, so now let's go over and calculate the depreciation expense for years 1, 2, and 3, knowing those first two steps. All right, so remember, you're going to start out with the cost minus the residual value, which in this case is $410,000 minus $10,000. And then you're going to divide that by the estimated usage. In this problem, the estimated usage is 40,000 hours. Just showing my work here. So that will equal $10 per hour. Step 1's always going to be the same for every single year, so you don't need to recalculate that. To get the depreciation expense, you just have to multiply the rate. This is step 2, by the way, times your actual hours. And in year 1, we had 3,000 hours. That will give us $30,000 of depreciation for the first year. Now for the second year, you're going to do exactly the same thing, and the rate doesn't change. The rate will always be $10, and you're going to multiply that by the actual usage. So I'm just going to fast forward a little bit so we could get through year 2 and year 3. All right, so now we got years 2 and 3, again by multiplying the rate times the actual usage for the respective years. Now we're going to go over the journal entries. The journal entries, the debits and credits are always the same each year. Your debit's going to be depreciation expense, and we're going to have that for the first year for $30,000, and your credit will be accumulated depreciation, which is a contra asset, and that contra asset will bring down the equipment. So again, year one was $30,000. And you're going to do the exact same debits and credits at the end of year two and year three. For year two, it's $35,000, and for year three, it's $40,000. I'll quickly do the journal entries for year two and year three so we can get to the net book value. All right, now that we got our journal entries done for years 1, 2, and 3, now we could calculate the net book value at the end of year 3. In essence, you could calculate the net book value after each year, but this particular problem is asking for end of year 3, so let's do that. The net book value can be found on the balance sheet. On the balance sheet under property, plant, and equipment is your equipment, so there it is. Our equipment is $410,000, and right underneath it is the contra asset, the accumulated depreciation account, which will bring down the equipment account. So after year 3, really you're just adding the 30 plus the 35,000 and the 40,000 because you credited accumulated depreciation for all three. It's in the title, it accumulates. So add those three up and we get 105,000. You're going to subtract that because again, it's a contra asset. And if you take the difference between the 410,000 and the 105,000, that will give you your net book value, in this case of 305,000. This number becomes very important when in the future you decide to sell or discard the asset. You'll need to know what the net book value is to compare it to what you are selling it for.